Hi, everyone. This is Bill Cantor with Cantor Wealth Management. I'm a financial planner in Skokie, Illinois. I'm also the author of the book, Your Best Retirement Plan, How to Eliminate Market Risk, Avoid Taxes, and Have Money for the Rest of Your Life. The book discusses a way to achieve tax-free retirement income using a unique kind of life insurance policy, cash value life insurance policy called Index Universal Life, where you buy the smallest amount of life insurance that you can to keep the policy tax-free, according to IRS rules, and the rest of the money goes into the cash value. So you lower the fees in the policy by buying a little bit of life insurance. And the criticism of life insurance and the IUL is that the fees are higher than brokerage fees. The fees are high, and I'm going to compare them today to a typical brokerage account, making some assumptions, comparing apples to apples, a brokerage account and a Index Universal Life policy structured properly. And we're going to see that the fees in an IUL policy can be half of the brokerage fees. The first thing you have to look at is what are the typical fees in a brokerage account. So CNN Money said it's not unusual to see some advisors charging 1.1 to 2% a year to manage a portfolio, and that's on top of the underlying fund fees, which in the case of actively managed funds can easily add another 1% or more to your annual tab. So that's somewhere between 2 and 3%. Moreover, USA Today said that it's a crime that they are extracting somewhere around 3.5 to 4.8%, which is the lion's share of what the market returns on investments. Workers end up giving away half of their retirement savings. Forbes magazine did a article called "The Real Cost of Owning a Mutual Fund," and they said that the total cost and fees can be between the annual expense ratio, the annual assets under management fee, the annual trading expense, can be 3.57% in a typical mutual fund or account. Finally, John Bogle, the founder of Vanguard Funds, said that we eat up all of our dividends with stock expenses. In the industry, you could easily say it doesn't give a damn. Fees easily wipe out a huge portion of the yield on stocks, more than 63% of your money. So to summarize all that, the CNN says that fees can be between 2 and 3%. USA Today says 3.5 to 4.8%. Forbes magazine says 3.57%, and John Bogle says 63% of your money. In spite of all that, we're only going to use, for this comparison, we will use a brokerage fee of only 1.5% annually and an average rate of return of 7%. Now, most brokers, if they make you 7%, they're going to charge you more than 1.5%, but that's what we're going to use for this comparison. So the assumptions we're going to make in our apples-to-apples comparison between Index Universal Life and a brokerage account, for the IUL, we're going to use a male age 51 in good health. In the brokerage account, we're going to use a person age 51. $100,000 goes in over 5 years in both accounts. That is $20,000 a year over 5 years. The brokerage account is going to earn 7% a year in our assumption. The IUL will earn 7% a year because there'll be a 0% floor and a 13% cap. We're going to use a company that uses that kind of floor and cap. That means that if the market goes down, you get credited with nothing each year. And if each year the market goes up on the 1-year anniversary of your policy, you get up to 13%. So if the market goes up 14%, you only get 13. You get up to the cap, or if it goes up 12%, you get all 12 because you get up to the cap of 13. That has averaged about 8% over the last 25 years. We're going to assume 7% as a crediting rate. Again, there's a zero floor, so you can't ever lose in the market. The IUL is tax-free because it's life insurance. The brokerage account has taxes that I'm going to show at 20%, but I'm not going to deduct it from the account. You can do that on your own, but I will show that there is some tax has to come out when you're earning 7% a year. You got to pay some tax on it. The fees in the brokerage account, as I said, will be 1.5%. The fees for the IUL policy will come from the expense report of the policy. So the next thing is, here is the expense report of a policy. Every IUL policy comes with an expense report. This shows you all the expenses you'll pay over the entire life of the policy, at least the assumption at the moment. That could change, but these are the expenses in the policy. So you see here the premium going into the policy, the $20,000 a year over 5 years. This premium is what buys you this $346,000 of life insurance, which is not only good life insurance, but it also keeps the policy tax-free. And this here shows all of the expenses in the policy, the 3 types of expenses in the policy. Premium load, every time you make a premium payment, they take a 5% out. The cost of insurance, to buy this $346,000, and the additional expenses of initially $1,500, and goes down from there in the policy. That's to pay the insurance company and also administrative costs, and also pay brokerage commissions. So I'm just going to copy these columns into my spreadsheet when I'm going to do the comparison. Now, as I said, these fees can change. It's not a contractual obligation, but anything can change. Your brokerage fees can change. Markets can go up and down. Taxes can go up and down. So anything can change. But unlike a typical brokerage account, if you asked your broker, give me all the fees I'm going to pay in this account for the next 35 years, they could not do it. Here, the company prices this insurance policy, and they give you these fees that you are most likely going to pay. Again, they can change, but if they change, they often change for the better, because cost of insurance goes down over time as people live longer. Actuarially, cost of insurance goes down, so this might even be less. But I'm just going to copy these to the spreadsheet. So here's our spreadsheet showing the IUL policy on this side and the brokerage account on this side. So you see the premium outlay, you put $20,000 a year each year for 5 years into the policy here, and you put $20,000 a year into the investment account over 5 years. These are the expenses: the load, cost of insurance, and additional expenses. These three is in this column. The total policy cost and fees. This number is this 3134 is a total of these three numbers. So these are total costs and fees each year in the policy. And here is the fees at 1.5%. Now you're earning 7%, taking out the 1.5% fee, and then there's your balance, 21,079, and then you add another 20, and each year you do that. So you see here at the end, after 35 years, your total fees in the policy, in the IUL policy, it's $68,332, and in the brokerage account at 1.5% fee, it's $139,000. You see the difference: $68,332 versus $139,194. And the reason for that, even though the average fee you paid in your IUL policy is 1.9% versus 1.5% in the brokerage account, because up front you pay a lot more money in the IUL. That's why it gets sort of a bad rap that the fees are high, because initially you got to buy. You're paying, the cost of insurance is very small, is small, but they have to buy all this insurance on you. So they have to buy a good amount of insurance, and therefore the total cost and policy costs in the beginning are higher. Whereas in the fee in the brokerage account is very small, $321. But look at year 25. In year 25, the cost of insurance is really small. It's only $374 because they have all this cash that they're going to give you back. If you make a death claim here in year 25, they have to give you $374,000. $349,000 is your own money, right? They're giving you back plus $25 of their own. So the cost of insurance is really small. So look at the total. You only pay $821 to manage this $350,000. It's less than 0.25% in year 25. It's 0.25% in year 30. Whereas your brokerage account, it's true, it's only 1.5%, but it's 1.5% on the entire $335,000 in year 25. So you're paying $5,113 here versus $821. You're paying in year 30 $6,650 of costs out of the policy in year 30 versus only $1,263 in year 30 in the IUL. So that's why the IUL is cheaper to own. It's half the fees. The other thing to keep in mind is that some of the fee in the IUL is buying this death benefit. It's not just a fee that goes away, it goes to a broker. It's buying good life insurance, tax-free life insurance. And the other thing to keep in mind is that taxes at some point have to be paid. So I didn't take out the taxes from this account. This $567,000, which is the account value after 35 years versus $718 in the IUL. So not only is the IUL much $150,000 better, but at some point you got to take out these taxes, either along the way if it's a typical account, or at the end when you take out the money if it's a qualified account. And if you take out the taxes from this $567, it brings that down to what, $440,000-ish versus the $718 in the IUL. So if you take out the taxes, it's even a bigger fee. Taxes are the cost as well that you have to pay. The other things I want to point out here is I efficiently manage this policy, meaning I wrote it on a 51-year-old. Now, if this person was 61 years old, the costs would be higher. The cost of insurance would be higher. If the person was 41 years old, it'd be cheaper, and these cost would be even less. I also structured this properly, paying it in over 5 years. That's an efficient way of structuring an IUL policy. If instead of putting the $100,000 in over 5 years, I put, let's say, $10,000 over 10, or 66 over 15, that's a less efficient way of structuring a policy, and these costs would be greater. Still would not be what it is in the brokerage account, but it's important to structure a policy, work with the advisor to structure a policy in the most efficient way possible, and there are a number of ways to do that. The last thing I want to point out is, and this is why the IUL gets sort of a bad rap on the fees, is that up front, look after 10 years. After the first year, as I said, IUL is costlier in the first few years. And if you look after 10 years, the IUL total cost in year 10 is $32,501. So it should be considered a longer-term investment. Whereas the brokerage account over 10 years, after 10 years, the fees are only $15,670. However, if you assume a 3% fee structure instead of 1.5, and 3% is not unreasonable, then the fees would be $29,515, very close to what the IUL fees are. So your fees might be greater, might be less. You can, and again, taxes might go up or down. You may have a big market crash here, and your account value goes down terribly. So I'm just trying to point out in this that apples-to-apples comparison over time, the IUL is a much less expensive thing to own. The actual cost of the policy is less, and again, you're buying the life insurance, which is going to go to your beneficiaries at some point, in all likelihood. Okay, so if you want more information about how Index Universal Life might be a good thing for you, or to discuss any comments you have on this video, please call me at 847-674-6470. Thanks a lot.